When we think about financial markets, our minds often jump to the familiar stories, the meteoric rise of Bitcoin, the frenzy of traders chasing profits, the endless debate about what's next. Yet beyond the charts, beyond the hype, there exists a principle far more powerful than the most popular assets, something that operates not on speculation alone, not on volatility, but on human behavior itself. This is bigger than Bitcoin. It is not confined to a digital token or a single market. It is a universal truth about opportunity, perception, and the way we engage with risk. The most profound forces in trading and investing are never the tools we use, but the mindset we bring to them. For too long, people have believed that success in markets comes from following trends, memorizing patterns, or waiting for the next big thing. They think that if they just buy the right asset at the right time, wealth will follow, and sometimes it does, but only by chance. True consistency, real mastery comes not from external events, but from internal understanding. When you look at Bitcoin, you see headlines, volatility, and stories of fortune. What most fail to see is the psychological framework behind it: fear, greed, hope, doubt, and the inability to remain objective. These forces are far greater than any coin or stock. They are the undercurrent that drives every decision, every success, and every failure. This opportunity, this idea that is bigger than Bitcoin, is rooted in awareness. Awareness of yourself as a participant in the market, of your reactions to uncertainty, and of your willingness to act with discipline rather than emotion. The market does not care who you are, or what you believe, or how much money you have. It is impartial, indifferent, and unforgiving to those who allow impulses to dictate action. But for those who understand the game, who recognize that the real asset is clarity of mind, the potential is limitless. People spend hours analyzing charts, debating tokenomics, and chasing predictions, yet they overlook the one variable that determines outcomes with far more certainty: their own mental state. The market's fluctuations are unpredictable, but your response to them does not have to be. When you develop the ability to see beyond the immediate, to recognize opportunity without attachment, you gain access to a force far more potent than Bitcoin itself. It's a force that can be applied across assets, across time, across any market. It's the difference between reacting to events and creating outcomes. To grasp this, one must let go of the obsession with quick wins, the desire for validation, and the fear of being wrong. The discipline to remain objective, the courage to stick to principles, and the patience to wait for the right conditions. These are the elements that compound quietly, invisibly, until they produce results far beyond what a single cryptocurrency could ever offer. Understanding this truth is the threshold to real mastery. When most people think of opportunity in financial markets, their minds instinctively go to the tangible, the next hot stock, the next cryptocurrency, the next asset class that promises exponential gains. We are conditioned to equate opportunity with a concrete, measurable object, something we can point to, analyze, and quantify. We read headlines, track prices, and study trends as if the secret to success lies solely in discovering the right asset at the right moment. But if you step back and examine the pattern of long-term success, you begin to realize that the assets themselves are secondary. What truly defines opportunity is not the instrument you choose to trade or invest in. It is the mindset you bring to the game. Mindset, in this context, is far more than a vague notion of thinking positively or being confident. It is the total framework of your beliefs, perceptions, and attitudes toward risk, uncertainty, and potential reward. It is the lens through which you interpret the market signals and decide how to act. Opportunity, therefore, is inseparable from your mental approach. Trader with the sharpest analytical skills but a fragile mindset will see potential everywhere, yet fail to act consistently. They will chase patterns, overreact to news, and surrender to fear and greed. Conversely, a trader with a disciplined, objective, and aware mindset can navigate the same markets with clarity, patience, and confidence, turning even modest fluctuations into consistent results. The difference is not the market, it is the mind. To understand this fully, it is essential to consider why most people misidentify opportunity. We live in a world obsessed with outcomes rather than process. If a particular stock doubles in value, everyone celebrates the person who picked it right, as if the insight alone created the result. Rarely do we pause to examine the underlying process that led to that success, or the role that chance, timing, and psychology played. This fixation on outcomes fosters a superficial understanding of opportunity. It teaches people to focus on the wrong variable, the asset itself, rather than the one variable over which they have real control, their own mindset. True opportunity exists in the ability to perceive the market objectively, to recognize potential without attachment, and to respond in a disciplined way. A mindset rooted in clarity and self-awareness allows you to see opportunities that are invisible to those who are merely chasing price movements. When your decisions are governed by emotion, every fluctuation is either a threat or a promise. Fear exaggerates risk, making even minor setbacks feel catastrophic. Greed inflates potential, creating illusions of certainty where none exists. In contrast, a mindset trained to remain calm and objective evaluates each situation based on probability, not hope. It measures potential, not expectation. It assesses risk, not desire. Opportunity, therefore, is a function of perception. The same chart, the same market conditions, the same event can present vastly different opportunities to two traders depending on their mental state. Consider the role of discipline in this context. A disciplined mindset does not act impulsively. It waits for the conditions that align with a well-defined strategy. It does not overreact to short-term noise or the pressure of others' opinions. By cultivating discipline, you create the conditions in which opportunities can be recognized and acted upon without interference from emotion. Markets will always present scenarios where profit is possible, but only those whose mindset allows them to see clearly and respond calmly can capitalize consistently. The rest are left chasing illusions, forever searching for the perfect asset rather than realizing that the true asset is their own ability to engage intelligently and consistently. Equally important is the willingness to accept uncertainty. Opportunity in markets is never guaranteed. It is probabilistic, not deterministic. A mindset that fears loss, avoids risk, or clings to certainty will fail to engage with opportunity at all. In contrast, a mindset that understands risk as an inherent part of every decision can evaluate potential without paralysis. This acceptance of uncertainty transforms the very nature of opportunity. It allows you to enter trades or investments with a clear understanding of what could happen without being enslaved to what must happen. The difference is subtle but profound. The asset itself is irrelevant. The mind dictates whether the situation is truly an opportunity. Another aspect of mindset is emotional resilience. Markets are inherently volatile. Conditions change constantly. Headlines shift sentiment overnight. A mindset that is rigid, reactive, or overly attached to outcomes will interpret these changes as crises, missing opportunities as a result. Emotional resilience, however, allows you to observe changes without panic, to adapt without losing composure, and to recognize potential in situations that others dismiss as too risky, too uncertain, or too confusing. Again, the underlying asset is secondary. The mind transforms chaos into opportunity. Experience alone does not guarantee this mindset. Many experienced traders fail not because they lack knowledge, but because they have not mastered their mental approach. Knowledge allows you to recognize patterns and make educated guesses. Mindset allows you to act on them consistently. You can understand every metric, every trend, and every prediction, yet still fail if fear, overconfidence, or impulsiveness dominates your behavior. Therefore, the most powerful opportunity is not in the charts, the news, or the market mechanics. It is in the ability to see clearly, think rationally, and respond effectively under pressure. Even in emerging markets or revolutionary technologies such as cryptocurrencies, the principle remains the same. Bitcoin, blockchain, or any other asset may appear as the opportunity to the untrained eye, but those who achieve lasting success focus not on the asset, but on the mental skills required to navigate the market intelligently. They understand that the environment is unpredictable, that volatility is constant, and that fortune favors those whose mindset transforms uncertainty into potential rather than threat. Without this mindset, even the most promising asset can be a source of stress, loss, and frustration. The implication is profound. The moment you shift your focus from external assets to internal mastery, you unlock a level of opportunity that cannot be replicated by simply following the next trend. Markets will always change. Assets will rise and fall, headlines will come and go, but the clarity, discipline, patience, and emotional resilience cultivated within your own mind are portable, adaptable, and timeless. They allow you to perceive opportunity in every environment, not just in the rarefied few that happen to align with a lucky choice. This is the foundation of true success, and it is what separates those who merely participate in markets from those who consistently capitalize on them. Most people underestimate the role of emotions in their financial decisions. They believe that success comes from knowledge, analysis, or strategy alone. Charts, indicators, and trends are treated as the keys to consistent profits, while emotions are dismissed as minor distractions, something to control or ignore. Yet the truth is that emotions are the engine driving nearly every decision we make in markets. Without awareness of our own emotional state, even the most brilliant strategy can fail. Even the clearest analysis can become irrelevant. And even the most disciplined plan can collapse under pressure. Emotional awareness is not a soft skill. It is the very foundation of consistent success. When we talk about emotional awareness, we are talking about something much deeper than simply noticing that you feel anxious, excited, or frustrated. It is the ability to recognize the subtle ways in which emotions influence perception, judgment, and behavior. It is the understanding that fear can make a small loss feel catastrophic, that greed can exaggerate potential outcomes, that hope can blind us to risk, and that regret can prevent decisive action in the future. Emotional awareness allows you to identify these internal reactions in real time, to understand their impact on your decisions, and to create the space to respond rationally rather than react impulsively. Consider fear, for example. Fear is not inherently negative. It is a signal that risk exists, that something is uncertain. Yet most traders allow fear to dictate their actions rather than using it as a guide. Fear can cause hesitation, leading to missed opportunities. It can cause panic, leading to premature exits. It can magnify losses in your perception, making a temporary drawdown feel like a permanent disaster. Emotional awareness helps you recognize the physiological and mental signs of fear before they dictate behavior. It allows you to step back and ask whether your hesitation is a reflection of actual risk or simply your mind reacting to uncertainty. By doing so, you can act with clarity and objectivity, turning what would have been a paralyzing emotion into a tool for disciplined decision-making. Greed is the other side of the same coin. It pushes you toward impulsive decisions, overexposure, and excessive risk. When you feel greed, it is easy to convince yourself that every opportunity is a guaranteed win, that risk is temporary, and that success is imminent. Emotional awareness allows you to notice the signs of greed before they lead to poor decisions. You can acknowledge the excitement without letting it override your rational analysis. You can recognize the urge to overreach and consciously choose to stick to your strategy. The ability to observe greed without being consumed by it is one of the hallmarks of consistent success. Hope and regret also play critical roles. Hope can make a losing trade feel justified, causing you to hold on to positions far longer than is rational. Regret can make you hesitant to act on a new opportunity, as the memory of a previous loss haunts your decision-making. Both emotions can distort perception and interfere with rational action. Emotional awareness is the key to disentangling these feelings from the actual facts in front of you. It allows you to see situations as they are, not as your emotions wish them to be. This distinction between perception and emotion is what separates those who succeed consistently from those who oscillate between euphoria and despair. Developing emotional awareness requires practice and discipline. It begins with observing your internal reactions in the moment without judgment. It requires asking yourself questions like, what am I feeling right now? Why am I feeling this way? How is this influencing my decision? Over time, these reflections build a kind of self-knowledge that becomes automatic. You start to notice patterns in your own behavior, recurring emotional triggers, and predictable reactions to certain market conditions. Once recognized, these patterns can be managed, mitigated, or even leveraged. Emotional awareness turns unpredictable feelings into predictable factors that can be incorporated into your strategy. Another critical aspect of emotional awareness is the understanding that emotions are not obstacles to be eliminated, but information to be interpreted. They provide insight into your own values, priorities, and expectations. For instance, discomfort during uncertainty may indicate a lack of confidence in your preparation, or it may reveal a need to refine your risk management. Excitement may highlight opportunities that align with your instincts, but it may also signal overconfidence. By interpreting emotions as signals rather than directives, you create a feedback loop that enhances decision-making rather than undermining it. Emotional awareness also enables adaptability. Markets are inherently unpredictable. Conditions change constantly, and rigid adherence to strategy without emotional insight can be as damaging as acting impulsively. When you are aware of your emotions, you can recognize when your mindset is clouded, when patience is required, or when decisive action is necessary. This ability to adapt in real time, to balance emotion with reason, is what allows some traders to thrive consistently while others fail despite similar knowledge and skill. Finally, emotional awareness fosters consistency. Most traders' results fluctuate, not because the markets are inconsistent, but because their emotional responses to the markets are. Fear, greed, hope, and regret create cycles of overtrading, hesitation, and impulsive behavior. Awareness breaks these cycles. By monitoring and managing emotions, you create a stable foundation for decision-making. You are no longer at the mercy of every market swing or headline. Instead, you respond to opportunities in a calm, measured, and disciplined way, which is the essence of consistent success. Many traders and investors approach the markets as if they are personal, as if the market somehow knows them, judges them, or reacts to their hopes and fears. This is a fundamental misconception that leads to frustration, inconsistency, and repeated losses. Markets are impartial. They do not favor the knowledgeable over the novice, the experienced over the beginner, or the confident over the cautious. They do not punish mistakes out of malice or reward correct predictions out of kindness. The market operates without preference or emotion. It is a reflection of collective decisions, supply and demand, and innumerable factors beyond any single individual's control. Understanding this impartiality is essential to building consistent success, because once you accept that the market is indifferent, the responsibility for outcomes shifts entirely to your reactions. When you realize that markets are neutral, you begin to see that every outcome is a direct result of your own decisions rather than the market's behavior. The rise or fall of a stock, commodity, or cryptocurrency does not dictate your success. Your interpretation and response to that movement do. Two traders can experience the same market conditions, the same asset movements, and the same external news, yet one will profit while the other loses. The difference is not luck. It is how they perceive the situation and act on it. Impartiality is a reality that removes blame from external events and places it squarely on the participant. Once you internalize this principle, you are empowered to control what truly matters, your reactions. Reactions are shaped by perception, expectations, and emotional responses. Many traders react impulsively because they have not distinguished between observation and judgment. When a market moves against a position, the untrained mind immediately labels it as bad or wrong, triggering fear, panic, and rash decision-making. When the market moves in favor, greed, overconfidence, and recklessness can take over. The market itself is not good or bad, it is impartial. It simply presents conditions that allow disciplined, aware participants to capitalize and unprepared participants to falter. Recognizing this neutrality allows you to pause before reacting, to evaluate your choices based on probability and strategy rather than emotional impulse. Impartiality also removes the illusion of control. Many traders operate under the false belief that they can make the market do what they want through timing, predictions, or sheer force of will. This belief is dangerous because it encourages overtrading, excessive risk-taking, and attachment to outcomes. The market does not respond to desire, it responds to forces beyond your influence. The key to consistent results is not attempting to bend the market to your will, but shaping your reactions to align with reality. By acknowledging the impartial nature of the market, you stop fighting external forces and begin mastering internal ones. One of the most important consequences of this understanding is a shift in responsibility. When outcomes are viewed as reflections of external conditions, it is easy to blame the market, bad news, or unforeseen events for losses. This mindset creates helplessness and reinforces patterns of inconsistent behavior. When you accept that the market is impartial and that your reactions determine results, accountability shifts inward. You are no longer a victim of circumstances. You are an active participant whose mindset, discipline, and decision-making dictate success. This shift in perception is critical because it transforms every loss into feedback rather than failure, and every gain into a measure of skill rather than luck. The impartiality of the market also highlights the importance of preparation and emotional control. Since the market does not adjust to your needs, understanding your own reactions becomes paramount. You must anticipate how you will respond to gains, losses, volatility, and uncertainty. Without preparation, The neutral forces of the market will expose weaknesses in perception, discipline, and emotional control. With preparation, impartiality becomes an advantage rather than a threat. The market provides endless opportunities, and the ability to recognize and act on them is determined by the clarity and consistency of your internal responses. This principle applies equally to short-term trading and long-term investing. Day traders experience constant fluctuations that can provoke emotional overreactions, while long-term investors face uncertainty over months or years. In both cases, the market remains indifferent to desire, expectation, or impatience. Those who understand and embrace this impartiality are able to respond consistently regardless of market conditions. Their decisions are guided by probabilities, not hope, by strategy, not emotion, by discipline, not impulsivity. In contrast, those who misinterpret market movements as personal validation or rejection will continue to oscillate between overconfidence and despair, unable to achieve sustained results. Another aspect of market impartiality is the recognition that opportunity is ever present, independent of outcome. The market does not reward or punish arbitrarily. It simply presents conditions that can be exploited if the participant's mindset and reactions are aligned with reality. This realization liberates traders from the tyranny of short-term results. Success is no longer measured by isolated wins or losses, but by the consistency and quality of your reactions to the environment. It is possible to lose repeatedly yet remain disciplined and prepared for the next opportunity because your focus is on process rather than outcome. In essence, the impartiality of the market forces a deep self-inquiry. You cannot control price movements, but you can control your response. You cannot eliminate uncertainty, but you can prepare to navigate it. You cannot predict every event, but you can decide how you will think, feel, and act in the face of it. This understanding shifts the focus from external conditions, which are uncontrollable, to internal mastery, which is entirely within your influence. It reframes success as the consistent application of awareness, discipline, and rational decision-making, rather than the pursuit of luck, timing, or external validation. Impartiality also creates psychological freedom. When the market is viewed as neutral, emotional reactions become data rather than mandates. Fear, greed, impatience, and frustration are no longer forces that control action. They are signals that can be observed, analyzed, and incorporated into conscious decision-making. This allows a participant to maintain clarity even in volatile or challenging conditions, turning emotional awareness into a strategic advantage. By internalizing the impartial nature of the market, traders cultivate resilience, patience, and adaptability, all of which are essential for long-term consistency. In the fast-paced world of trading and investing, there is a persistent allure to speculation and hype. Markets are filled with stories of overnight millionaires, sudden surges, and dramatic price movements that promise quick rewards. Social media amplifies these narratives, creating a sense of urgency, competition, and the fear of missing out. Many participants are drawn to the excitement, believing that rapid gains are the true measure of skill or insight. Yet, the reality is starkly different. Long-term success in markets is rarely the result of chasing the loudest trend, following the most hyped asset, or reacting impulsively to every new headline. It is built on discipline and patience, qualities that allow you to navigate uncertainty with clarity, maintain consistency under pressure, and capitalize on opportunities that others overlook while being consumed by noise. Discipline begins with a clear framework. It is not a rigid adherence to rules for their own sake, but a conscious commitment to a process designed to maximize probability and minimize unnecessary risk. Discipline requires defining criteria for entry and exit, setting risk parameters, and maintaining adherence. Even when emotions tempt deviation, it is the ability to act according to plan rather than impulse, to follow methodology rather than speculation. Many traders fail because they treat strategy as flexible, bending it to suit their current feelings or the latest rumor. Discipline protects against these tendencies. It ensures that decisions are rooted in rational evaluation, not momentary excitement, which is the foundation for consistent results. Patience is the companion to discipline. It is the understanding that opportunity is not a commodity that must be seized immediately, but a condition that must be recognized and waited for. Markets will always present setups that align with your strategy, but attempting to force opportunities where they do not exist is a recipe for error. Patience allows you to observe, analyze, and wait for the conditions that provide the highest probability of success. It is the willingness to sit on the sidelines, to resist the pressure of perceived urgency, and to accept that the best trades or investments often appear infrequently. Without patience, even disciplined rules can be undermined because the mind seeks action for the sake of action rather than results. The contrast between speculation and discipline is striking. Speculation thrives on immediacy and uncertainty. It rewards impulsive behavior in the short term with the illusion of success, but it punishes the unprepared over time. Hype magnifies this effect by creating social pressure, amplifying perceived opportunity, and making deviation from the crowd psychologically uncomfortable. Discipline, by contrast, requires detachment from noise, emotional regulation, and a focus on probabilities rather than certainty. It creates a buffer between external chaos and internal decision-making, allowing you to act when conditions are favorable rather than when emotion demands action. Patience enhances this buffer. It prevents overtrading, reduces exposure to unnecessary risk, and allows time for analysis to catch up with impulse. It ensures that discipline is not mechanical or rigid, but adaptive and contextually informed. Patience is not passivity, it is active observation, readiness, and the ability to strike decisively when the conditions truly favor success. Those who master patience avoid the pitfalls of hype-driven markets, preserve capital, and position themselves to exploit opportunities that others miss due to impatience or fear. Emotional stability is deeply intertwined with discipline and patience. The mind's natural reaction to gains and losses often undermines rational decision-making. A trader who reacts to small wins with overconfidence or to small losses with panic is surrendering control to emotion rather than process. Discipline and patience provide the structure to counter these tendencies. They anchor behavior in strategy rather than sentiment, allowing decisions to be consistent across fluctuating conditions. This consistency compounds over time, creating an advantage that speculation and hype cannot match. The most successful participants understand that markets are probabilistic, not deterministic. Every trade or investment carries risk and no prediction is guaranteed. Discipline allows you to respect these probabilities, to manage risk appropriately, and to accept losses as part of the process rather than as personal failure. Patience allows you to wait for situations where probability is most favorable, reducing the frequency of marginal decisions that increase emotional stress and degrade performance. Together, discipline and patience transform uncertainty from a source of anxiety into a strategic tool, enabling rational action in the face of chaos. Another element to consider is that hype is fleeting, while disciplined processes are sustainable. Trends emerge and disappear. Social sentiment shifts constantly. Participants who chase hype are always reacting to what has already happened or what they believe may happen, often entering positions too late or under poor conditions. Those who cultivate discipline and patience create an internal environment that is immune to these fluctuations. Their results are not tied to transient excitement, but to the consistent application of proven principles. Over time, this consistency generates compounding benefits that far exceed the fleeting gains achieved through speculation. Discipline and patience also foster confidence. Confidence derived from skill and preparation is far more reliable than confidence derived from luck or temporary market moves. When a disciplined, patient participant engages the market, they do so with clarity, awareness of risk, and understanding of probabilities. This type of confidence is not shaken by short-term volatility, rumors, or peer pressure. It provides the psychological stability required to make high-quality decisions repeatedly, which is the essence of sustainable success. In practical terms, discipline and patience manifest in behaviors such as waiting for clear setups, adhering to risk management rules, resisting impulsive trades, and maintaining focus on long-term objectives. They require self-awareness, the ability to monitor emotional reactions, and the courage to defer gratification in favor of higher probability opportunities. The result is a state of operational excellence, where actions are deliberate, outcomes are probabilistically advantageous, and emotional interference is minimized. This is what allows some participants to consistently profit while others, equally intelligent and knowledgeable, fail because they are seduced by noise, hype, and impulsivity. Most participants in financial markets focus on what is immediately visible: the charts, the short-term price swings, the gains or losses on a trade made yesterday or today. The human mind is wired for instant feedback. We naturally measure success in terms of what can be observed immediately. This emphasis on the short term creates a trap because the true essence of mastery is not captured in individual wins or losses, but in the ability to see beyond immediate gains. Mastery emerges when a participant understands that each trade, each decision, each market movement is a fragment of a much larger continuum, and that long-term success is the result of consistent behavior, disciplined process, and mental clarity applied over time. To see beyond immediate gains requires a shift in perception. Most traders evaluate opportunity by outcome. If a trade earns a profit, it was good. If it loses, it was bad. This outcome-oriented thinking reinforces emotional reactions. Fear, regret, euphoria, and frustration become tied to each result, which clouds judgment and increases susceptibility to impulsive behavior. Mastery, however, is process-oriented. It emphasizes correct execution over short-term outcomes. When a participant focuses on applying principles correctly, risk management, position sizing, entry and exit discipline, emotional control, the immediate gain becomes secondary. Over time, the consistent application of sound processes produces favorable results. The ability to see beyond immediate gains is rooted in recognizing that every action contributes to long-term development and cumulative success, whether the immediate outcome is positive or negative. Patience plays a critical role in this perspective. Seeing beyond immediate gains requires the willingness to defer gratification. It requires resisting the impulse to judge a trade or investment solely by its short-term performance. The market will frequently present situations where rapid results are possible, yet these situations are often accompanied by higher risk and uncertainty. A participant who evaluates success in terms of immediate gain may chase these opportunities, sacrificing consistency for the illusion of quick rewards. Mastery demands patience, the ability to wait for high probability setups, to accept temporary drawdowns, and to maintain confidence in a process even when results are delayed. This patience is not passive. It is an active engagement with the market where preparation, observation, and readiness are continuously applied while resisting the urge for instant outcome validation. Emotional regulation is also a cornerstone of seeing beyond immediate gains. Immediate results provoke strong emotional responses. A small win can trigger overconfidence, leading to excessive risk-taking, while a small loss can provoke fear, hesitation, or revenge trading. Mastery requires emotional stability, the ability to observe these reactions without being controlled by them. By maintaining objectivity, a participant can focus on probability, discipline, and strategic application rather than short-term emotional reinforcement. The market is indifferent to these emotions, and outcomes in the short term are often random. Emotional mastery allows a participant to navigate this randomness without being derailed, to treat each trade as data rather than validation, and to remain aligned with long-term objectives. Another dimension of seeing beyond immediate gains is the recognition of compounding. Success in markets is rarely linear. It is cumulative, built upon a series of disciplined decisions and consistent actions over time. Each correct application of strategy, each controlled reaction to uncertainty, and each observation of personal behavior compounds into greater skill and understanding. By focusing on long-term growth rather than immediate profits, participants harness this compounding effect. They build mental resilience, refine execution, and cultivate intuition for probability and risk assessment. This perspective transforms temporary setbacks into opportunities for learning and long-term improvement rather than sources of panic or regret. Mastery also entails the ability to detach from outcomes without detaching from responsibility. To see beyond immediate gains is not to ignore results. It is to recognize that the market will reward process over time, not luck or impulsive reactions. Participants must take full responsibility for their actions, while understanding that short-term results do not define skill. By detaching emotionally from immediate outcomes, they avoid the destructive cycle of reactive behavior. This detachment creates space for reflection, analysis, and adjustment, which are essential for ongoing growth and adaptation in dynamic markets. Experience reinforces this principle. Seasoned participants understand that the market is inherently unpredictable in the short term. Price movements are influenced by countless factors beyond individual control, including news, sentiment, and collective behavior. Evaluating success based on short-term gains is therefore unreliable and misleading. Mastery arises when participants internalize this reality, focusing instead on consistent application of their methods, careful risk management, and ongoing learning. Each action is an opportunity to refine skill, strengthen discipline, and deepen understanding, independent of immediate results. The ability to see beyond immediate gains also requires humility and self-awareness. It demands the recognition that knowledge is provisional, that uncertainty is constant, and that overconfidence in short-term outcomes is a trap. Humility allows participants to remain teachable, to evaluate each trade objectively, and to learn from mistakes rather than reacting defensively. Self-awareness ensures that emotional responses, cognitive biases, and psychological tendencies are recognized and managed. Together, these qualities create a mindset capable of maintaining perspective across market cycles, resisting the temptation of impulsive decisions, and focusing on the factors that truly contribute to long-term success. Finally, seeing beyond immediate gains transforms the relationship with the market itself. The market is no longer a source of stress, fear, or validation. It becomes a laboratory for observation, practice, and refinement. Each trade is an experiment, each result a data point, each challenge an opportunity for growth. Immediate gains become secondary to the development of competence, consistency, and resilience. Mastery is achieved not through chasing transient profits, but through the accumulation of skill, insight, and disciplined behavior, all of which compound into sustainable success over time.